Bulls. Always bulls. You know? Yeah. What do you like? Huh?
What do I like? Bears.
You like bears?
Yeah.
That seems un-American. We're supposed to be about the bulls because America's a bull. Don't you want to be a bull, buddy?
No, it's a pig.
America is about bulls.
It's not about bulls.
Yeah, it is. I mean, you're 4 years old. You can confuse bears
Wrong,
and
7.
7.5.
8. I'm kind of.
What's up? What's up? What's up? Hey guys, how you doing? I'm just arguing with my beautiful young nephew here about what's cooler, bulls or bears. His name is Teddy. You want to say hi?
Hi.
What's better, bulls or bears?
Bulls.
Yeah. How old are you?
7.5.
Look at the muscles your uncle's got. Look at this. Look at that. Who's got the strongest uncle in the history of the world?
I do.
I mean, that's what I was thinking. That's what I was thinking. What's up? What's up? What's up? I mean, I have abnormally large muscles. I mean, there's no getting around that. Hey, Paul, what's up?
What's up, Kanal? Got a little workout in there?
I mean, I love this little kid. What's up with you? Where you been?
Doing good.
doing?
Let me get
Hold
this,
on here one
set.
sec. Let me make sure everybody gets in here okay. Boop, boop, boop. So, do tell. You are a ghost apparition currently.
I don't know what's going on. This happens every time. I don't know what. I have no idea what I've done here. I think it looks kind of cool, though.
It does. I mean, you're a ghost apparition, but it's working.
Do you know how I would fix this?
I do not.
Okay. Settings. Maybe I'll fix this for next time. Video HQ.
Oh. Yeah, we'll ask Evan one of these days.
Yeah.
We'll figure it out. So, do tell.
Yeah, I'm doing good. Doing good. Happy about the way the market acted today. We were waiting to see if there was going to be another big reaction to what's going on in the Mideast, but market held up well, so that's good.
It does. Any just random inklings? We've been like static for days and days and days. You think it's just a digestion?
I think part of it is the jobs report coming out tomorrow, and
because don't we have jobs reports like every couple of days? It seems like there's always
it does feel like it, but we didn't have a lot of outside of what happened geopolitically. We didn't have a lot of big news events this week. Mm-hmm. So I do think this market. It's been a weird market where back in the day we really didn't deal with this stuff too much. Jobs reports, unemployment,
never
unless there was a big surprise. The market didn't really care, but we're so sensitive now to what the Fed might do that every little data point gets parsed, and these at the end of the day these things don't matter. I mean, look at almost every time we've had something that's concerning, you get a big gap down for a few days and then the market will pop right back up, right?
Yeah, it's been it's very interesting because it's like you plan around these reports, and then the reports don't do nothing.
No. Well, where it hurts you though is when you're in positions, and if the report takes you out of some positions you might have because the market's overreacting. So I think that's been a big adjustment over the last 6 to 8 months, is these reactions have been so volatile just for a couple of days, and then we get right back on trend that usually we have the hard and fast rule, right? Your stop gets hit, you get out of it. But what we've been doing is waiting. Go ahead.
Do you think it's like just like an algo AI thing? Because the action's a little bit different than it used to be.
Yeah, I do think that's part of it. You get a little bit of a sell-off, and then the algos come in, and they know they're shaking people out.
Yeah.
And, they can get it. They can get it in good prices. So the adjustment we've made is we either loosen our stops, or if we have a stop, let's say random number, your stop was at 100
Mhm.
and your stock gap's down to 98 or 99. You've increased your risk a little bit, but it's enough to hold on and then just put a little hard and fast, stop maybe down to 97.50 or something. See if it holds on to that level. And that's worked out really well, where we've had a number of positions where we had these overreactions, overall market overreactions, almost took us out of good positions. We held on, and then we were able to, bounce back and take the profit. So I think you're always adjusting to what the market's doing, and that's been one of the big adjustments right now.
No, it makes a lot of sense because, even at the post Fed, like you got I wouldn't say a sell off, right? But like you just got kind of a little bit of a fade, and then the next
Right.
day, like people are probably selling into it because
Yeah.
they're like, oh, sell the news event.
What our, over the last 2 years now, what our rule has been for the Fed is wait 4 or 5 days. Don't jump to any conclusions. Not only that first day, but even sometimes that second and third day is a fake out.
Sure.
So, you're not in a rush. Wait 4 or 5 days for swings at least. The day traders, you guys can just jump on it right away right now and trade these reactions. But for our swings, we like to wait 3-4 days at least and just see, okay, where does the market settle? And there have been a lot of reversals of these initial kind of reactions.
There's been nonstop like reversals of reversals, it would seem.
Yeah, I've been, yeah.
So give me a rundown. How are you? I'm gonna give you the screen share, and I'll take mine off. How are you navigating currently the conditions? Because I noticed you've been actually you've been on a good little streak of recent. How are you adjusting your trading style and what you're doing with war, elections? You got earnings also coming up.
So, generally September, October is the period where you want to take a little risk off. Still, of course, you can still trade. There's always something to trade, right? But you don't have to get as heavy with your positions. Sure. You can risk a little less. If you're risking 1%, go down to 0.7 or 0.5%. Because September, October, just historically, there tends to be a lot of chop. You're in between earnings seasons, fall's coming. We're waiting for that November, December kind of move. So September historically is the weakest month, and then October can kind of go back and forth. So actually, give me a minute. I have my window open. Can you hear that out there?
Very lightly. I wouldn't worry about it.
Oh, yeah. Okay. So September, October tend to be kind of slow months or chop kind of months, and then November, December tend to be strong. And now we've got an election coming where everyone's basically waiting for an election. And historically, in election years, November and December are very strong. So traders will kind of pull back, trade a little less, and then get really heavy November, December because the odds are just so good starting next month once election's over.
So when you say the odds are so good November, December, like what are you basing this off? Like back testing, historical data?
Back testing the last 50 years. And
okay.
The numbers are, in general, the numbers, November, December, you have the biggest percentage gains month to month. And that puts the odds in your favor. If you're going long, that obviously you've got the kind of that tailwind going. Not only that, there are specific things that tend to move.
Okay.
We love trading small caps, right? Mm-hmm. Those are stocks that can really move. And small caps do their best in November and December.
That's true. The biggest gains I've ever had have always been during Thanksgiving week.
Right. During that period, it's interesting how it works. Thanksgiving week tends to be very strong going into the end of November. Get a little lull at the beginning of December, and then a really big push going into the end of the year where all the window dressing is going on. All these funds, they want to look good to their investors. They're buying up things. Small caps tend to do really well related to tax reasons or whatever it is. But really good time to trade. And then on top of that, election years are even better. So. Ooh. And it doesn't matter who wins. There's this tendency to think, well, if the Republican wins, that's going to be the best, for Wall Street, the market. Market doesn't really care. Market just dislikes uncertainty. Once that certainty is in, they know what to do. So they tend to be on hold. That being said, so everything I've said says be cautious right now. Don't trade too much. September, December, we've actually been very aggressive because while the overall market and, a lot of if you just look at the overall market, you look at the S&P 500 and the bulk of the stocks in the S&P 500.
Yeah.
Kind of languishing, going back and forth, doing nothing. there are pockets of the market that are very strong. And that's what we want to focus on. All we care about is trends, right? We don't care about the overall market. As long as we have, and at the most, a trader is trading 5 or 10 stocks at a time,
Sure.
right? So if you've got 10 or 20 good stocks on your focus list, and we've had some fantastic stocks, some fantastic catalysts, and that's what we've been focused on essentially, is the stocks moving on catalysts. So overall, market's not doing much, but we have these air pockets. And essentially 3 different pockets. And I've kind of divided up here. I think you can see my screen. There's the current market catalyst. There's the rate cut catalyst. And there's some interesting stuff going on with big tech.
Okay.
So the current catalyst is essentially what's going on in the Middle East right now and the China stimulus, right? And areas related to that are popping right now. That's the immediate catalyst. So China, China's instituting these stimulus plans. The China stocks have essentially been doing nothing for like 3 years now. If we pull up FXI, and we've rarely, there was a period where we were trading China like crazy, like maybe 5 years ago. But you can see here, essentially since 2001 here, been in a huge downtrend.
Yeah.
And while not only the U.S. but basically the world market is up here, China's been down here and still in that downtrend.
Okay.
But now we have that clear bottom formation, and then of course we know over the last few weeks this big pop here. So we're watching China. We haven't actually taken any China trades here because the pop came so fast that it was just too extended for us. I don't know if you've taken any China-related trades outside of day trading.
Only on the short side, actually. We did.
Yeah, that's smart. That's smart because you get these big pops, and then you have
we did the classic rubber band short yesterday on Futu.
Oh, fantastic!
And that's just on a day trade basis. So opening spike, first red candle, basically stop at the high of day and let it drift lower for most of the day. And that's your classic rubber band short, right?
Right.
It even might have been even more extended than that.
Right.
I didn't want to hold it overnight because the Chinese market's actually closed right now. So
so you don't know what's going to happen the next day, and
it's just moving on American stuff, but the market's closed, so we're just shifting it around on our own. So I just been doing day trading.
Extended markets, right, and in extended markets, you don't want to be chasing. Essentially, right? That's where you can really get caught. So there's this tendency, like most people aren't going to catch the first move. That's fine. This looks like it's the start of a trend. We've had this base forming. We look at accumulation distribution patterns. For our overall patterns, we don't necessarily trade, base our trade off it. But in terms of the overall pattern, we see definitely accumulation has been going on, right? When we see these big green spikes and very small red spikes, that's an indication to us that the big guys are buying. And now we see the spike here. So there's a big base here. My expectation is the bottom formation is we broke this range. We were watching, you see the line here. We've had this line marked. And yesterday we broke that line still at an extended condition, which I actually like. Because when you break a resistance level and you're already super extended, there's a good chance for a pullback. And that's what we're essentially waiting for. The pullback looks like it's starting now. We're going to watch to see where it kind of bases out at. And that's where we're going to look to start building our positions. And my expectation is we're getting to the start of a continuation pattern starting here. Some momentum really coming into the Chinese market now. So this is FXI, the ETF that takes the 25 biggest China stocks. It's kind of like the Qs for us. We can trade yen, which is a little, you're taking on more risk because it's 3 times leverage. So you can make 3 times the gains, but also 3 times the losses. But as swing traders, we like to trade these leverage ETFs to kind of outsize our gains because the underlying ETFs tend to move slow. So you can do yen, and yen is a little safer in the sense that how the China market is. All of a sudden, you'll be in a stock, and all of a sudden the government comes down on a company out of nowhere and ends up getting crushed. That maybe happens like 1 in every 50 times you do it, but when you get caught, it's not fun. So the yen ETF provides a little safety, but then there are a ton of fantastic stocks now, and I know you guys have been tracking them and trading some of them. I listed a few of them here. The big guys.
Yeah, show us your faves.
And then we're always watching Baba. And you can see here, it's running essentially with the overall Chinese market. Starting to pull back here. I would love to see this pull back to 1 of 2 spots, either the 9 EMA or the bottom of this range here. So we're watching, late this week. We're already up almost Friday, so maybe early next week, this thing can pull back to the 9 EMA or the bottom of the breakout bar and show a little strength at that level, a little confirmation that's going to hold that level. Those would be good spots to enter. Baidu, we're essentially seeing the same pattern with all of these. Baidu, very similar. These are the bigger Chinese stocks, a little safer, but then we have the real momentum players where you can get some real big percentage gains. Here's Sohu. This is only a 16 million float. And you can see, from early 2024 has already made almost 100% move. So this thing can really fly. This one's interesting. While the rest of the Chinese market was pulling back, Sohu was up 2% today. So showing relative strength, a little different because we're looking at mostly pullbacks. This one's actually breaking out of a range here. So I think we could, if we wanted to, we could enter this one today. There's Billy. Billy here. Similar pattern, pulling back here. This would be great if we could get a pullback here to the 9 EMA around 23. The nice thing is if we could get in here, and we're always thinking about risk reward, if we could get in here around 23, maybe place a 1 or 2 point stop, the top of the range is all the way up here at around 31. So you're looking at risking a point or two to potentially gain like 8 or 9 points.
Now, when you buy this kind of pullback, when you buy this kind of pullback, do you expect it to break out again, or because it's the first pullback, it usually just runs back to the old high and then consolidates?
Exactly. That's why our initial target is the old high, right? We're getting in at the support level, and the risk reward is so good on this pullback. Again, you can risk 1 or 2 points. The old high is at 31. So if you're entering at 23, 8 points off 23, you're looking at over a 50% gain that could happen like that. And you're risking very little, $1 or $2 to make 8. So really good risk reward, even if it doesn't truly break out and continue again. What I like to do is I'll enter here. Let's say I hit my target at the top of the range around 32.
Yeah.
I will get out and continue to watch. If it breaks that 32 range, I'll get back in.
Nice.
So Billy and also Neo, the kind of electric kind of
now,
the
Paul,
Tesla.
What's
China.
What's the advantage of just selling it at highs versus like trying to see if it's going to go anymore?
You can do that. What often happens is when you hit that resistance levels, those bag holders are getting out of their positions at that point, and you tend to often see these little pullbacks. So I like to take that profit there. And, I think you can think of trading as if you were to compare football and baseball. Mm-hmm. Baseball, you take your pitcher out, you have to get a new pitcher, essentially like a new stock, right? With football, you take your quarterback out, the next play you can be back in. And that's the way I look at it here, where I can take that trade off. And if it does clear that range, no problem. I just get right back in. Maybe I gave up a little bit. I got out at 32. I get back in at 32, 20 or 50. That's all right. So China, one of the big catalysts. The other big catalyst is what's going on in the Mideast. Energy and defense have been popping like crazy. We can look at the big ETFs. Here's the energy ETF, XLE. You can see here, energy has already been basing nicely. We've had this like 2-year base here, and we're watching. Notice within this base, while it tests the high, it's been making higher lows as well. So this thing is ready to break out. And I think the stuff that's going on in the Middle East is providing that catalyst now for a setup that has been emerging for essentially two years now. So energy definitely in play. XLE is the ETF. Easy way to play it again is leverage ETF, ERX, and then a few stocks. So when I have a leverage ETF like this, we can always trade the leverage ETF, and that's going to beat a lot of the stocks in that industry. ERX is actually 2 times instead of 3 times, so maybe not all of them.
It used to be
so I look for
times.
stocks. Yeah, it used to be 3 times. They changed it to 2 times. So what I look for is when there is a leverage ETF in an industry, what stocks do I think have the potential to beat that ETF? Otherwise, why not just trade that ETF, right? 3 of them that I've identified that are pretty volatile, that can really move, STNG, Valero, and SM. So if we look at STNG, we can see here sitting at 74 right now, has made a big percentage gain in 2024. If we look, it's been showing relative strength to some of the other energy stocks as well. So if you just pull up, say, CVX and look at the pattern it's putting, way down here, way off its highs. STNG showing relative strength, near its highs, didn't pull back quite as deep. So really nice pattern here, and it has already remounted the 50 and the 200-day moving averages. So it doesn't have that resistance level to worry about, whereas a lot of energy stocks are still below those levels. So it's already cleared a key level. If we were to enter here, right at 74, top of the range is about 84. So you're looking at a 10-point potential gain for maybe 2 or 3 points of risk wherever you place your stop. Valero, similar pattern. This one, a little below the 200-day moving average at this point, but when this thing moves, it can really move. So I think this one has the potential to beat as well. And then SM, another one that I think could beat the ETF. Oh, and we got our youngest trader here, huh? Look at that.
Uncle Paul. Yes, but
Hey, buddy. Hey, Colt. Next quarterback of the Detroit Lions, right?
but you.
Yeah. Hopefully, Colt. Hopefully, Jared Goff can
That's
last for
right.
another 18 years, and then we'll have Colt.
But look at look at this, my.
Wow, started him young.
Yeah.
He's a big boy.
Yeah, he is.
Wow.
Top 2% of his age.
All right.
Just but you look at this. Look at the strength. Look at the plank this kid can do. Look at that plank.
Already doing the weight training. Look at that. All right. So we have energy. We're one of the current catalysts.
Hey, Paul, one caveat. Have you ever noticed? Maybe I'm indifferent to this, but energy sucks. Don't they kind of suck to trade sometimes?
They suck to trade when you don't have a catalyst.
That's
So
true.
that's, and
It's the gaps that always get me because there's no intraday
Yeah.
range. They just
Right.
move on the gaps, and it always throws me off.
the thing with energy, when they move, they can really move. So you might get caught a few times, but then you hit it for a big win.
Yeah.
And we have the catalyst now. And one thing I want to differentiate between these two catalysts, I have number 1 and 2 here. The current catalyst, Mideast tensions and China versus the rate cut catalyst. These are very short-term catalysts. We don't know what's going to happen 2 weeks from now, a month from now. When we get together again in a couple of weeks or a month, we might say this is done.
Sure.
We're done with this, right? The rate cut catalyst, that's here for a while. And these are going to be sustained. The stuff related to the rate cut, that's going to be sustained for a while, unless something were to change with the rate cuts and all of a sudden they start increasing rates again, which I doubt is going to happen. But so these are short term. But if you lose on it, like, the way we've been talking about risk on these things, we're risking a point or two,
Yeah.
potentially pop and get 8 or 9 points. We're not just trying to get 2 to 1. We're trying to get some outsized gains on this. So if you lose a small little trade here or there, it's okay, because when you hit, you should be able to hit these pretty big. But yeah, you're right. Sometimes it can be frustrating trading energy on the fake outs.
It always, for me, retail and
and then-
energy stocks always the worst.
Yeah. And that's actually what we're talking about today too. But defense stocks as well. So ITA is a good ETF to just track. I don't trade this ETF because it's not quite that volatile. The stocks will be more volatile than this, and they don't have the leveraged ETF. But it's just to assess the industry. You can see it's been on fire. So there's some good stocks here. I know you guys have been trading some of these. So I have the standard kind of defense stocks we've all been watching. There are a couple of other stocks kind of related to defense, because we're in a whole different world now, right? It's not just the military stuff we think about, but cybersecurity has been very strong during this period as well. So one of our favorite plays is cyber here. It was on a huge run, 2023 to kind of early 2024, has been consolidating for months. And we talked about the box breakout, I think, last time we got together. Really good fundamentals. We don't pay too close attention to fundamentals, but I do like to pay attention on these stocks that were on huge runs and are consolidating. I want to see, like, does this have potential for breaking out and really running, or is this going to kind of top out or fizzle out? And the fundamentals can be can be a good predictor of that. And we don't parse it too much. Just look at the chart here. This is a percent change in revenue. Notice the revenues in the stock. You can ignore some of the other stuff. Here's a revenue quarter by quarter. Thing has been rising. The yearly revenue has been rising like crazy. So even while this thing has been consolidating for all of 2024, the revenues have been increasing. And that's the extent of our fundamentals analysis. Just looking at, okay, revenues are increasing. I like this one for a potential breakout. So if we go back to the chart now, we see it's been consolidating for a while. We're getting close to this breakout here. We're actually in this thing right now. We're anticipating the breakout because there's so many factors. One, cybersecurity is hot right now. Defense is hot right now. We have great revenues, great earnings on this stock. That it's a good candidate to try to anticipate the breakout. Normally when I have a box like this, I'll wait for the breakout, but occasionally we try to anticipate, and we're doing that with this one. We recently did it with Meta and took profits. If you're kind of analyzing the box breakout, we entered early on the Meta box breakout, and you can see these things, once they break out of these boxes, they can really run.
Paul, how do you determine when to be early versus when to get confirmation? Because I think everybody struggles with that, right? Sometimes when you get confirmation, it's like, oh, I bought it too high. So, and sometimes you get the anticipation and you're like, dang.
I think, you know, with trading, like, there's a science to it and an art to it. And this technical pattern is the science. And if you want to just play the science, you wait for the breakout. And there's nothing wrong with that. You don't have to try to anticipate, right? But if you have things that you think give you an edge, you've tested give you an edge, I'll go with if I've got a big edge, I'll go with it and try to anticipate. So with cyber specifically and Meta here, also another one we did was Melli. There were two kind of defining factors, and you can see how much Melli ran on the box breakout as well. So two things that really kind of supercharge the potential breakout is, one, what we just looked at. If you see a stock that has been while it's been ranging, continues to beat on revenues, continues to grow on revenues, more so than earnings, because a lot of factors go into earnings, right? They might have made a lot, but they did a lot of research that quarter. So, but the actual sales, actual revenue, what's coming into the company, if that keeps increasing and the stock is consolidating during that period, that's a very good predictor of a breakout. And if before the consolidation, it had made a big run going into that consolidation. So what you have is a stock that is just way extended. It's still a great company. The only reason it's consolidating is essentially it just needs to kind of digest these big gains, but it's still a great company, still has great revenues. So we look at that. Some of the technical patterns within the box. So you'll notice a common theme with all of the anticipation plays we do, we see higher lows. You know, we have the box, but as it's been forming the next lows within that box, we see higher lows. That's a good signal as well that, you know, there were buyers coming in before it actually tested the low. So I like that as well. And then, of course, the kind of industry analysis is in a hot area. You know, media obviously has been very strong. Related to Melli, cyclical retail, specialty retail has been very strong. And of course, with cyber, we have the catalyst of cybersecurity right now. So it's kind of an art. You're just kind of factoring all these different things. And if you have two of these things really aligning, I'll anticipate instead of waiting for the break.
Got it. So essentially, you're looking at market cycles, and then the specific stocks also cycle. Right.
So we have cyber, we have PanW. I don't think we need to go through all of these. You guys can look at them here in terms of what of the defense stocks. Let's just pick a few. I know you're watching these. Are a few here that are your favorites here?
Oh, I mean,
I think you mentioned KTOS, right?
Yeah. That one I'm in my IRA currently.
So here's KTOS, really strong move.
And Raytheon.
And if we look at this, it's got a high. There's still a lot of room till it hits resistance. You know, it's sitting at. You've got a high here at 34 post-pandemic, and it's sitting at 25 right now. Maybe a little extended for an entry right now, but we could watch for a pullback. A lot of these are extended. So we're not saying enter these right now, but these should definitely be on watch. And if we get pullbacks, we can potentially trade them. AVAV is pulling back right now, kind of forming a little mini box here. And I haven't looked at the fundamentals or anything, but overall has been a really strong stock.
It's
then of course
thin bastard. So I actually bought it on the first box. So like
back here,
many months ago. Yeah, the first box, I believe, like
right here,
close to yes.
Oh, nice.
And then I put in my IRA, and so I sold half essentially into the spike, and then I nibbled on some back at the 200-day moving average when I got
down here.
When not at the 200, but when I remounted the 9. And so now I'm kind of trading around it a little bit.
Yeah. Wow. So you timed this thing perfectly.
I like to do that
here, and then
for position trading at least. Like, if you got an awesome box, you may be able to get like 3 or 4 entries around it, but you have to be so diligent,
Nice. And then if it, what are you looking to do? If it breaks the high here, are you looking to add, or are you looking to take profits? What are you on what you have right now?
Yeah, I don't think I'll add it into the highs necessarily, but if I get like a flag or something, then I would so if I add into highs, I usually like the 9 EMA to be really tight. Just so I can just kind of minimize my risk a little bit. So like if it spikes through the highs, but the 9 EMA is like, say 10% away, then that's too much. I think that's too loose for me to add into. Like I would keep my shares, but I wouldn't add into it. But if like you got like a little handle that developed like right under the highs and the 9 EMA was kind of curling there, then you can really limit your risk to maybe like, 5 points or 10 points, maybe not 5 points, right? Because it's thin, but you could risk, you can minimize it to 10 points. And I think then it's definitely worth it.
Yeah. That's a good, what you just said kind of speaks to, it's not just picking the right stocks, it's the trade management around it as well.
Sure.
And, you have this thought out plan of, where you're going to get in, where you're going to get out. All right. So that's the current catalyst right now. Of course, that could change according to what's going on right now in China, what's going on in the Middle East. But those are the current catalysts, what we're really focused on. And, maybe in the overall market, we're being a little defensive. But in these areas, we're not hesitating. When we see these things set up, we're jumping into them.
Gotcha.
Then more of the long-term catalyst is the rate cut catalyst. So these areas were already anticipating the rate cuts. So they've already made big runs going into the rate cuts. They pulled back some, and now we're seeing continuation patterns, which we love. You get the pullback, and now you've got the secondary or third kind of runs in these. We got the first rate cut. The Fed has indicated 2 more rate cuts are likely to come. So that's good news. And then we'll see what happens, through 2025. But these areas should be sustained so what we're looking at is areas that are really impacted by the rate cuts. And 3 of those areas are retail. When there's rate cuts, good for the consumer. Consumer's going to go out and buy stuff, right? So it helps there. Of course, housing. There's no area more sensitive to rate cuts than housing. And when we think of housing, we're not only talking about home builders, but the home suppliers, engineering companies, mortgage companies. So all these things, anything related to how, even Home Depot, Lowe's, those types of things, all related to housing. And they've been flying. They're near all-time highs right now. And then industrials as well tend to move well. And we've got a few.
You got a fave out of those housings?
My favorite is kind of the easiest play, Nail, which is the leverage ETF. Very few things are going to beat that. And then Rocket Mortgage as well, for 2 reasons. 1, the stock has been flying. 2, one of my good buddies just became CEO a year ago, and he's doing fantastic. But if we look at RKT, you can see here, this has made a huge run, and it's probably beating Nail right now. So was it 7 at the start of 2024? Is at 20 now? So this gives you the indication that it's volatile and can really run. So this one's pulling back to the 50-day moving average, has dipped below, but I'll be watching for a remount to around 1920 for a potential entry. Then if we look at Nail,
it could break out any day, it looks like. Nail.
Yeah, and then Nail here, consolidating this range here. This is one that maybe we could even anticipate, but definitely if it breaks 175, 176 here, we could enter. And then, the standard go-tos. Actually, one stock that is new on my list that I've really liked is AZEK, Building Materials. It's been consolidating for a while. I've been kind of assessing this as a potential like box breakout. What I liked about it is when, that November to early 2024 run when housing was crushing it, AZEK was one of the leaders, and now it's consolidated for a while. Again, these things that really run have good, solid revenues and fundamentals. When they make their secondary move, they tend to move just like they did on their first run. So the high's a little ways away at about 50, and we're at 46 right now. So maybe this is a candidate for an anticipation play as well.
Hot.
So housing, retail, industrials, and then finally, we're always watching big tech, obviously, and we've divided big tech into essentially two areas. One, the relative strength and the value plays. The value plays are the ones that are pulled back. Relative strength are the ones that are at new highs and breaking out. Meta, which we just took profits on, I'm looking to get back in a good spot. We had the box breakout, got extended here. We exited at better than, I think, 3-1. I was a little concerned with what was going on with the Middle East, so I just thought it's a good spot to take profits.
Sure.
But now, bouncing off the 9 EMA, looks ready to break Wednesday's high, so maybe we could get back in there. Netflix is near highs as well. You can see here, it's actually right at the all-time high. So maybe an anticipation play here with Netflix. These guys do have earnings this month, and there's some time. And oftentimes the big techs, you'll get these run-ups going into earnings. So if you see a nice pattern and you're 2 to 3 weeks out from earnings, you can enter with the hopes that you get a run-up going into earnings. And generally, we don't like to hold swings through earnings, right? But like say we entered this thing at 706 and it runs up to say 740 going into earnings. You've mitigated your risk to where if it was a gap down, you wouldn't take a loss, or you'd take a small loss probably. It's not going to go down, I don't think, 100 points, but if it went down 40 points, you'd be protected. You're giving up profit, but the potential for the gap up allows you to kind of hold through that and mitigate your risk.
Yeah.
So you can think about that with some of these big techs that are all reporting between about 10, 15, like 15th of the month to about the end of the month.
Paul, do you notice like when you have stocks that are so late in the cycle, like this Netflix, for example, right? It's up, I don't even know how many hundreds of percent since the beginning of 2023, that the chances of like the big gaps on the earnings, do they increase or decrease in your estimation because you're just getting so long in the tooth?
Yeah, we look for indications of that. And so far, it's, timing these kind of things is really tough, right? Like we could have thought it was long in the tooth here, and then it just kept going back,
and that's what I was curious.
It's always tough to predict. What I like to look at is when a trend is feeling like it's long in the tooth, watch the pullbacks. Sure. What's happening on the pullbacks? If the stock has been tending to pull back to the 9 EMA or the 50-day moving average, and all of a sudden now it's getting these deeper pullbacks to the 200-day moving average, or it violates the 200-day moving average, and then you start to see distribution set in, you start to see these big red candles coming in, that's usually the indication that this trend can't sustain itself. A topping pattern might be forming. We're not seeing that right now in Netflix, so it's been holding up. But yeah, you're definitely right. When these things get long in the tooth, you should watch for that. I also like here's the all-time high, and it has been consolidating for a good 6 months under the all-time high. So I think getting the break of the all-time high, it's consolidated for a while. It's not short-term extended going into the breakout. That I think we're okay for now. Apple's another one showing relative strength. Apple might be indicating what you're talking about. Like Apple obviously has made this huge run.
Yeah, it looked like it was going to break out a couple days ago.
Yeah, and then notice the difference. We were looking at Netflix. The volume was still good. Nice tight pullbacks before the next run. It just looked like a nice pattern, right?
Sure.
Whereas Apple's kind of all over the place, these volatile moves. And then look at these big red candles. It's been happening for a while. So this is the one I'd be more concerned with should I pass on this one and maybe go for Netflix or Meta versus Apple here. And then So these are the relative strength plays. And then the value plays are the ones that have been lagging a little. They had deeper pullbacks, but they're offering really good risk rewards at support levels right now. So the big one that's been lagging has been Google, which was the leader throughout 2024, but had the deepest pullback here. There's various reasons for this. There were potential antitrust reasons. The whole AI market kind of pulled back. So this was a part of that. Microsoft too, NVIDIA as well. And this did violate the 200-day moving average, but has come back very strong. What I like a lot about Google is, there's tendency to say maybe, well, Netflix is stronger. It's at all-time highs. That's true. It is a stronger stock right now. But the risk reward is so good here, especially if you were thinking, maybe not a standard like couple of days to a week or 2 week swing. But if you're willing to try to ride a trend, this thing here, you enter here at 165, maybe place a stop about 5 points at 160, 161, target the top of the range at 190. You're looking at potentially 35 points on 5 points of risk. So the risk rewards on these deep pullbacks are really good. We're in NVIDIA right now. And you can see here, this is a little.
Give me an honest answer. Has anybody ever hold Google for 35 points? Yeah.
Look at this thing. Look at this thing. Maybe not now, but this thing has. Look at the runs.
I know, but are you gonna hold Google for 35 points? Not a chance.
You don't have Google in your IRA.
I got Google's, but
you have to
for 35 points.
You better have it in your IRA.
I get 10 points at Google. I'm like, damn it.
you're
3 weeks of work to get that 10 points. I'm taking it.
All right, so there's Google, Microsoft here. This was looking really strong, and then it's pulled back. I don't know I haven't seen any news come out on why this would be happening, but watch this one, testing the moving averages. It shows some strength here and gets back over the 90 MA, so you get an entry around 430. That would be a really good setup as well. And then Amazon here was showing a lot of relative strength. Did not react well to its last earnings, but what I like about it is it recovered very quickly.
Yeah.
And the revenues have actually been strong, and institutional ownership has stayed strong. It just didn't beat the expectation. So you get this big gap down, overreaction, came back very quickly, almost hit all-time highs again, and pulled back. So watch for this thing, either a rebound in the 90 MA or some strength around the moving average here. I think there's a really good potential. There's potential for a good trade in Amazon as well. So actually, all of these, maybe not Apple's not really on my radar, but these 5 here, and I don't have Tesla on it. Tesla is kind of just a broken pattern right now. But these 5 or 6 here, we have some potential entries here. And again, if you don't want, kind of like China, if you don't want to be beholden to one of these stocks here and earnings is coming up and we can't hold through earnings, you can trade the ETF FNGU. Which
it's got a good ATR.
It has exposure to about 10 of the different big techs. AMD, we don't have AMD on this list. AMD is included in it. I think Intuit as well, or Intel, one of the two. But it has 10 of them, divides them pretty much equally between the 10 stocks, the big techs. And you can see here a nice pattern here, a low risk, high reward pattern here as well with FNGU. And this is 3 times leverage as well.
Not bad.
So essentially, everything we're looking at right now, probably to the election, unless anything changes. Of course, we're always looking for new trends.
Who's winning? Who's winning? Just say it. You won't get canceled.
Who do I think who's winning?
Yeah, the election.
Should I tell you what I hope as a trader?
You're a bettor. You gamble. You're a poker player. Who's winning?
Okay, so last time.
I personally don't care who.
I feel like this is going to be the situation where it looks like Harris is winning, and then we're going to wake up in the morning and Trump won. I don't know why I feel. I don't know why I feel like that. But I will tell you this as a trader. Forget our political opinions, what we want, and all that. Historically, we were talking about historical data, November, December, right? I told you in the beginning of this, it doesn't matter who wins for the market.
No. That
November, December will be very strong. There's one situation where the market really flies historically, and it's a little bit surprising. It's when a Democrat wins, but Congress is split. And I think the market likes that because it likes the idea that nothing will get done, right? Because Congress is split and you have a Democrat in there. So that kind of tells you a lot can't get done. and the market flies in that situation. So when you're watching this, take your political affiliations out and just look at it as like a political or a trading kind of scientist. That situation is going to be very good for the overall market.
Gridlock Congress has always been the best.
Yeah, for the market it is. For the market it is.
The Democrats can't do anything that stupid, but then you have somebody polite that at least is speaking to everybody. It's kind of how a market like.
There we go. That's a good summary. That's a good summary of that.
San Francisco, how'd they look in the 49ers? A lot of injuries.
It's been a slow start to the season, but I think we're going to come out of this really good. We got our backup running back looking good, so I'm not that worried about McCaffrey. All our guys are getting healthy. I think we're going to make a run here. We're going to make like a 4 or 5 game run.
Okay. This is kind
Detroit's looking good.
This is the big last hurrah in some ways with Brock Purdy about to get the Jordan Love money, the Tua money.
Oh yeah, they won't be able to pay all these players then. Yeah, but I think it's the last game of the season, December 30th. San Francisco against the Lions could be deciding home field advantage. You got to come down to San Francisco.
I know.
we'll make a game of it. I mean, you can wear your Lions gear. I'll wear my 49ers
By the way, the Detroit Tigers are probably going to the World Series too. So.
Oh yeah. They might be playing. They might be playing the Padres.
It's straight out of the major league, man. Yeah. These guys were left for dead a couple months ago.
Yeah, so we have potential for that Lions San Francisco matchup, and then the San Diego Detroit matchup as well.
Good stuff, guys. Paul is in, our swing trading room. He also has a free trial. You can kind of watch him do his thing. He's got nightly reports. He does alerts, of course. But the big thing is he's always spending time teaching. He's got a very in-depth newsletter that he's doing, most nights for the team to get everybody ready. So you're not depending on him to just follow along. Like he's there to, he's prepping you way in advance. And so if any of you guys are a part-time trader, swing trader, it doesn't have to be a part-time trader. Like I quit when Paul taught me and I quit my job, I was just a swing trader. I didn't consider myself a part-time trader, even though I was working and just, trading part-time. But there's not really a difference between like money you make from day trading, swing trading, options trading. It's really what you're good at and what you like. Anybody got any last thoughts? Paul, any words of advice for people the last 2 months of the year?
Focus on these areas, October, and then get ready for November, December. That's when you really want to supercharge your trading. Watch those small caps. One thing I didn't mention here, we'll talk about it more as we get into November. Also, watch the yearly leaders because that's the spot where all these institutions, these funds who weren't in those stocks, they want to look good to their clients, and they do this window dressing where they get into those. So you see these big runs in those stocks as well, even if they look extended. My expectation is we're going to have a fantastic October, November, December.
Then we do what we do, people. I love you guys. Peace. Paul, thank you as always for having us. Guys, you know where to find